Hello, everyone. Evening, everyone. Welcome to day 18 of Project Options Cashflow. All right, this is I'm Possible Investors, Terrence Tan over here. All right, good to meet all of you again tonight. Hi, Jacqueline. All right, if you're in the room right now, leave a comment, say hi. All right, hi, Josephine. All right, hi, Zen. Hi, Mary. I hope all of you had a great day over here. All right, hi, Uncle Tan. So we're gonna get started on time today. Okay, so same drill. If all of you are here with us again, do help us click on the share button for the videos, and I'll be posting a summary sheet of today's strategy discussed onto the shared post over here. All right, on your profile. Okay, all right. Now, so it would be great if you could leave some comments at the top before you share it out, so your friends would know what the video is about, all right? And it could benefit them by just having a look and watching it together with you. Okay, tonight's topic is going to be something really, really interesting. I'm going to cover how you can achieve what we call risk-free returns with options over here, okay, in the stock market, if you really want to do so. Okay, now, so that's our strategy for discussion tonight. So same drill, we'll go through the strategy. Okay, we'll go through the things inside, all right, the items inside and how it's formed, and then we'll go through from there. Okay, all right, how to never lose, how do you design the strategy, okay, how do you make tweaks to the strategy, okay, and then going through some live trade examples after that. Okay, how do you pick a stock to fit this particular strategy model to be able to yield the maximum benefit out of the strategy. Okay, all right, now, so without further ado, if the rest are just going to stream in a little bit longer, I'm just going to start tonight's session off over here. Okay, now, so again, once again, if all of you have not joined our Telegram channel as yet, okay, let me share with all of you what's the stock lingo for today. Our stock lingo for today is this word called covariance. Okay, covariance measures the directional relationship between the returns of two assets. Okay, all right, now, so it simply means that if we have a positive covariance, it means that the asset moves together. Okay, and if we have a negative covariance, it means it moves inversely opposite from each other. Okay, now I think one of the common way to probably explain this is we'll probably have most on most days we'll probably see Dow Jones and S&P index move in what we call a positive covariance format. Okay, because ultimately they represent the index of the U.S. market. So if one's up on big for the day, all right, the other is probably going to follow suit. Okay, but the S&P 500 and the volatility index is probably something where you see a negative covariance over here, where if we have the index up, right, usually you see volatility drop, and if you happen to see volatility go up for the day, it usually represents that the market is actually going down. Okay, all right, now, so that's our sharing of the stock lingo for today in our channel over here. All right, now, so if you're in, all right, maybe you could share it with your friends as well. Okay, get them in so they could learn a little bit about stock markets and also get notified when we start doing our live trading sessions one day of every week, okay, in the month of July. Okay, all right, now, so this month we're going to cover all the different strategies that is possible using options to create returns for yourself. Okay, starting from next month, one day every week. Okay, when the US markets are open, we're going to do a strategy and use it on live trading environments and pick a trade and educate all of you further. Okay, all right, now, so without further ado, let me get started with today's session. Now, so today's session is what we call the no risk trade strategy with options. Okay, technical term to it is called the collar trade. But today I'm going to discuss not the standard collar trade. I'm going to discuss a modified format to the entire trade. Okay, now why do I want to modify it? I'll share with you a little bit later on. Okay, now, so once again, before I start officially, if you have not clicked on the share button, do remember to click on it. Okay, and we will be posting the link for you to download the summary sheet for today's strategy that we'll be covering in the session. Okay. All right, now, so welcome to I'm Possible Investors, Project Options Cashflow for the next 30 days in the entire month of June. All right, we've just crossed the halfway mark over here. All right, and thank you for, thank you if you've been joining me on a day-to-day basis throughout so far. Now, just as a standard disclaimer before we begin the session, investing represents risk of loss. So anything that I'm discussing throughout the session is meant to educate you, right, and let you know more about options as an investment tool. Okay, any stocks that I'll be using, all right, do your own risk assessment before taking on those trades. Okay. Now, so Project Options Cashflow, the Portfolio Builder series. So yesterday and the day before, we were covering two different strategies that you could use to build your portfolio, right? And today we'll cover the third one, okay, and also the final strategy. Okay, now, so today I'm going to discuss the I'm Possible Modified Collar. Okay, now in brackets, no horse run. All right, now, so if you are Asian, if you're Singapore and Malaysian, you probably hear of this term a lot. All right, so no horse run strategy. Okay, now, so the main purpose of the strategy is how to never lose. How do you design the strategy to achieve that? Okay, and what kind of tweaks can you make to the entire strategy? Okay, yes, Zen. All right, you're right. I missed that step out again. Oh my goodness, thanks, Zen. Okay, here we go. Yes. All right, thank you very much, Zen. Okay, now, so today's strategy of discussion is going to be sell-put spreads. Okay, this is better for all of you now. Okay, so, sorry, today's strategy is not sell-put spreads. Oh my goodness. Give me a minute. I knew something was wrong. Now I got it right. Okay, thank you very much. Sorry for the delay over there. All right, just want to make sure everybody's on the right track. Now, so today's discussion of strategy is going to be I'm Possible Collar. Now, how do I make such a strategy simple enough for you to understand? First, if you've been joining us since day one up to today, you have heard all the different strategies that I've discussed so far. So I'm Possible Collar is simply a formation of two different option strategies together with ownership of the stock. Now, so stock market investing usually involves owning stocks. Okay, that's for the long run when you're trying to build a portfolio. Now, but when you buy stocks, one of the worries that you usually have is, of course, the downside risk. Okay, now, so even sometimes when you buy the best stocks, you're worried if the stock goes down. Okay, now more so when we are looking at January or February earlier this year. Okay, if I ask you to buy any shares, no matter how great the company is, you're probably packed with yourself some downside risk. Now, if you want to cover up those risks, all right, it's definitely doable when it comes to options. What's in exchange? What's in exchange is definitely the potential returns that you stand to make. Okay, it's a give and take over here, right? You want a lot of safety, then you've got to give some up in terms of the returns you can make. But of course, if you can stomach some risk, then of course you'll be able to seek out much better potential returns. Now, so let me go into the strategy right now. Are all of you ready? Okay, if you're ready, leave a comment. Let me know you're ready. All right, and I will match up with your readiness over here. Okay, right now, so you're ready to discover what's I'm Possible Collar, the no risk strategy. All right, leave a note. Tell me you're ready. Okay, in the comment section, and I'll begin officially. Hi, Wyman. All right, hi, Christine. All right, great. Christine is ready. All right, who else? Who else is with us and you're ready? Josephine, you're ready. All right, great. Gary's ready. All right, Gary's ready. Zen is always ready. All right, okay, now, so let's get started. Okay, now, so what's I'm Possible Collar? So first, step one, you have to own a stock. Okay, now, step two, you're scared of the downside risk. So what do? Right, so what do you do? Now, so what you do is, right, first, you go out there and you start selling a covered call. Okay, now why do you sell a covered call? Because you own the stock, right? Go out there and sell a call option so you get to collect some money, right? So selling the call option is for the sake of collecting some money in the process of selling the call options. Okay, now, and when you do that, give me a minute over here. Right now, when you do that, you get paid, right? And when you get paid, you turn around, use those money that was given to you, right? And you go out there and you buy a put spread. Okay, the normal caller, all right, the normal market caller only asks you to go out there, spend the money, and buy a put option, right? But usually when you do that, right, you may have to spend the entire amount that you collect over here, all right, and sometimes even more than that, in order to get a full protection on the stock. Okay, but when you do so with what we call a put spread, right, by buying the put spread, you will spend less money doing so, right, and that means there is money left over. Okay, now, so you get to collect the offsetted amount in this entire example. Okay, now, what kind of stocks is this best used on? All right, obviously the stocks with high risk. Okay, now what do I mean the stock with high risk? Okay, there's a contradiction over here, as Zen will probably highlight soon. All right, okay, now, and that is the fact that usually with high risk stock over here, we have much more downside risk. All right, but yet again, we probably want the downside risk because we seek out the big potential on the upside as well. Now, so if you sell a covered call, that means you're actually limiting the upside on the stock. So that sounds like contradictory over here. Now, so when I say, high risk stocks, right, the best relevance right now in the entire market would probably be oil stocks. Okay, now, why do I say oil stocks? Because of what happened with oil prices. So oil prices are going to remain very unstable throughout the rest of the year, right? But yet it gives us a big potential to be investing in oil stocks, especially big oils, right? In the event that oil prices can actually recover, which means when they hit the negative price level, that may be the bottom in oil prices, and we could start seeing a rebound to higher oil prices from there. Now, so that means companies like Big Oil, ExxonMobil, the big boys are going to benefit from higher oil prices if that happens, and the stock price is going to go up. Now, will that happen? We don't know, right? Is there a lot of risk? Yes, it probably is. Right now, so what do we do over here? Right, first, because it's a big oil company, and of course, because it's ExxonMobil, right, it definitely pays something called dividends. Now, so dividends is paid when you own these stocks. That's definitely a perk when it comes to owning these kind of oil stocks. And as you realize, if you pay $44 to buy ExxonMobil right now, okay, you're yielding about almost close to 8%, right? 8% in an entire year. That's not too bad after all. Right, but of course, you're going to highlight to me that's because there is a very high risk in this stock. Now, so what you can do is then you turn around, right, and you sell the 45 strike call option. Now, the stock is sitting at 44, all right, so you go out there and you sell a slightly higher call option. Right now, so 45 call option will pay you somewhere around 490, right, probably somewhere around 490 over here, somewhere in the middle, right, and that's a collection to you, right, into your account. So I'm going to write this over here as a plus. Okay, now if we're going to do this for a long expiry date over here, because you want to own the stock, right? It's probably going to take time for everything to happen, right? So we're going to sell a long-term call option with about a $1 upside potential, right? Because the strike is at 45, right? We'll take a look at the diagram after this, okay? All right, the $1 capital gain potential, right? And we'll turn around, right, and we'll buy the nearest strike put option, which is 42.50, right? That will cost us around maybe 540, right? Okay, and after that, all right, we're going to remember to sell a put option as well to turn it into a spread. Now, so when we do that over here, all right, 32.50, all right, we could probably sell it for somewhere around 210, all right, 210. All right, now, so doing so, it will give us let's see, 3, all right, 330. Is that right? No. Yeah, 330. All right, okay, so that means we have to pay somewhere around 330 over here. All right, okay, but somehow the broker suggests that I could do the entire order for 159. All right? So if they say I can do it for 159, means I can probably get a 159 credit, right, and get this order filled. Okay, now, so if this means this, that means also if I buy the stock at $44 right now, okay, my break-even price is going to be $44 minus 159 credit, which I'm going to get. Okay, now, so that brings my break-even price on the stock to 42.42. Now, and you realize you're protected from 42.50 onwards. So if your break-even price is lower than the protection that we have set, and we have bought this over here, that means we're never ever going to lose money. That's why it's a no horse run strategy. Right now, so before I go further, does everyone get this? Right? Is everyone getting this over here? All right, now, how many of you are excited about this strategy actually? All right, now, how many of you are excited about this strategy where you can create a no-loss strategy? All right, okay, that means no matter how you look at it, all right, you're probably not going to lose any money even if the company goes bankrupt. Okay, now, if you like and you're excited about this strategy, leave a comment and tell me you're excited. All right, tell me you're excited. Looks confusing? Not really, Zen. All right, when I go to the diagram, it's going to be much easier. Right, everything that you see in long sentences is probably going to look a little bit confusing, but when you go into the diagram, it's probably going to look much better. Okay, all right. All right, now, no one's excited. All right, no one's excited. Maybe I should wrap up. All right, wrap it up and we'll move along. All right, now, really no one's excited at all, right? That means you're all willing to take some risk. Confused, right? Right now. Okay, now, so maybe I'll ask this question a little bit later. Okay, now, let me go back to my slides. Let me show you what happens over here first. Okay, now, so this is the entire strategy. Okay, now, so in diagram format, this is how it's going to look like. Okay, now, so I paid, my mouse disappeared. Okay, now, I paid $44.01 to buy the stock today. Okay, all right, now, then I went ahead and sell a call, which means I get paid. Okay, I get paid some credits over here, all right, and then I spend some money to buy a put spread. Okay, so this is going to be a negative, right? So this is going to be a debit, right? But this amount is more than this amount that I'm paying, so I'm left with a positive net credit. Okay, how much? 159. As you've seen in the slide over here, I can place the entire order in the red column over here for 159 credit. That means when you see credit, just like a bank account, money is coming to you, right? Money is coming to you right now. So that means what happens now is, all right, you have ExxonMobil trading over here, right? At the moment, right? All these options expire in January 2021. Okay, right now. So if it goes up, okay, you would have to sell your stock to someone else at the price of 45. Okay, so the maximum profit you're going to make is going to be $1 on the stock. Okay, $1 on the stock plus, right, the premiums that you're collecting up front. Okay, that's the maximum profit you're going to make. Now, what happens if it stays? If it stays, right, so this money is yours to keep, plus probably 2 dividend payments. Okay, 2 dividend payments. Okay, now, what if it goes down? All right, what if it goes down and down and down? Let's say it goes all the way down. All right, okay, now let's say it goes all the way down to 35. Okay, if it goes all the way down to 35. Okay, now, so if it goes all the way down to 35, that's when your 42.50 protection kicks in. All right, so remember, if you buy a put option, right, you have the right to sell the stock to someone. At what price? At 42.50. Okay, right now. So buying a put option gives you the right to sell the stock, right, at this price over here, which is the strike price called 42.50. Okay, now what's the benefit of this entire strategy? Which means if the stock falls anywhere below 42.50, you're protected over here all the way up to 32.50. Okay, all right, now, so you're protected for the entire $10 drop, all right, that this stock could make. Now, So what will happen if it goes below 32.50? All right, if it goes below 32.50, all right, that means you're gonna have what we call paper losses. Okay, now, so yes, there is still a risk, all right, of losing money. That's in the event that the company goes bankrupt. So if you believe that ExxonMobil is going to stay around, all right, but there's some threat to the prices right now, okay, it could go down maybe by another 10 to 15%, all right. So this modified collar is going to help you protect those downsides, okay. All right, now, so it gives you a protection of 44 all the way down to 32.50. So that's about a $11.50 drop, okay, that you're protected from. Now you realize $11 off $44, which the current stock is, you are protecting yourself by another 25% drop. Okay, so this protects you from a 25% drop in the current stock prices. So imagine doing this on an entire set of blue chip stocks over here, all right, and having a downside protection of 25%, right? I think that's a pretty decent protection that you have on over here, right? And despite structuring the entire trade, you still leave a little bit of an upside potential, right? As you see over here, right? And you also get someone to pay you for doing that. Okay, so someone is paying you to protect yourself, right? Up to the tune of a 25% downside. Okay. All right, now before I go further, questions? Okay, questions. Anything you're not clear about so far? Okay, now, so anything above 45 brings about a max profit scenario, all right? Okay, so anything on the downside, you're protected all the way up to 32.50. Okay, now, why do I say you will not lose any money when the stock is somewhere in the middle? Right, that's because today, if I buy the share, I pay 44.01. But by doing the sell call and buying the put spread, somebody is going to pay me 159 for that. That means my break even or my cost of share is actually 44.01 minus 159. Right, and you saw earlier that brings us to somewhere along the lines of 42, which means my break even is somewhere here. Right, but my protection kicks in the moment it crosses this line. So that means I wouldn't have to lose. Okay, now, what do I mean when I say paper losses? It simply means, all right, when it goes below both the put option strike, all right, nothing is going to happen. You're going to get to keep your stock over here, all right, but you will make a profit of $10 from this entire put spread. Okay, so you're going to make a profit of $10 on this entire put spread. Now, so that means if the stock goes to $30, right, you would have lost a total of 14.01, right? 14.01. Okay, but you have already collected $10 and a further 159 over here, right? And probably 2 times of the dividends payment, which for ExxonMobil is worth 87 cents per quarter over here, right? So that's another almost 170, right, to go. Okay, so 170 plus 159 plus $10 over here. All right, so that brings us to about, let's see if my math passes the test. 1170, 1270, 1329. My total collection would be 1329 inclusive of premiums and dividends and profits from the put spread. Now, so if I add this up over here, you can see, right, $30 plus 1329. All right, that will bring me to a price of around 43.29. But I paid 44.01 to buy the share, which means I'm still looking at a small little loss, right, of about 80 plus cents, right, 80 plus cents on the stock. And this is what I mean. Since I still have the stock over here, this loss that I'm looking at is paper losses. Okay, paper losses. Okay, all right, now, Sai, so I hope I answered your question over there. What do you mean by paper loss? Okay, that means if you still keep the share, right, are you looking at profits right now or are you looking at losses? Okay, all right. So let's answer Lydia's question. VSell, right, is to reduce the premium for the buy 42.5, okay, 42.5. Yes, that's right. That's right. Because if you realize, let's go back over here. Welcome, Sai. Great. Get clarity over there. All right. Here we go. Okay. Now, so you realized over here, Lydia. All right, Lydia. All right. If you simply go out there and buy 42.50 put option, all right, it will cost over $5 over here, which means it is even more than what we get for selling the call option. So eventually, we're going to end up paying to protect our stock. Okay, so by adding on, all right, and turning around to sell the 32.50 strike put option, all right, I'm able to collect some additional premium for that. Okay, and that in turn reduces my cost, all right, of buying a protection on the stock, right, and that leaves me with some net credit, right, from the entire trade structure. Okay, Lydia, all right, I hope that addresses your doubts. Anyone else, all right, anyone else with doubts over here? All right, if you don't, all right, we'll probably start going out there and look at some returns and some numbers. Okay, now first, let's talk about how do you use this strategy. Okay, now what's the focus? The focus of applying such a strategy, right, is really on controlling the downside risk. Okay, welcome, Lydia. Right now, so if you start to feel that any stock, all right, any particular stock that you're owning at this moment, okay, at this right moment right now, okay, you feel that you're starting to have limited upside, all right, but all right, a really, really big downside that may be happening, all right, and at the same time, the stock that you're owning actually pays you dividends, all right, and you don't want to let it go, maybe because it's simply too good to let go, all right, then you would think about structuring a collar trade, right now, okay, because structuring a trade to get someone to pay you, right, to protect up to 25% downside on the stock, I think you can't really complain, right, with something like that. Yeah, all right, you can't really complain with something like that. Imagine you own a car right now and somebody is willing to pay you, right, to get an insurance policy for a car, right? How ridiculous is that? Okay, all right. Now, next, you have to be willing to accept a lower ROI, right, to have, you know, a much lower risk, right, or in fact, sometimes even no risk. Yeah, okay. Now, so it must be executed on high dividend yielding stocks because those dividend payments over here, right, is going to add to your potential returns that you can make, right? Okay, now next, if you're really, really scared to die, then this might be a strategy to get you started and going in the stock market, right? Because I have met people, right, who no matter how I convince them, for example, Coca-Cola is a great company, they just keep going, no, the stock price could still drop, the stock price could still go down, the stock price could still, you know, go bankrupt. Yeah, okay, now, I don't know, all right, now, if you really feel that Coca-Cola could go bankrupt, then, you know, maybe the stock market is probably not a place for you to look at entirely, right? But with such a strategy, then maybe we could get them to get their feet wet. Yeah, all right, now, so protected, better, all right, you want something that's protected, right, yet giving you better than fixed deposit rates of return over here, right? So that will probably be the goal that you want if you're executing such a trade strategy. Okay, right now, so James has a question over here. So James' question is, if the loss goes beyond 32.50, right, James, don't do that. Don't do that. Okay, now, you'll probably be better off just holding on to the stock. All right, James, all right, this is not a trading strategy, okay, which means this strategy is just to, you know, protect your downside risk, but at the same time, get somebody to pay you to do that. So, you know, you're capping up your upside risk, leaving some room for an upside risk, but you're really wanting to protect the stock from the downside. So, you know, our main biggest benefit will probably be the dividend payments that the company is going to pay us. Right now, by, you know, what you're saying of rolling the put over here, it really doesn't make sense because, right, when you do something like that, right, that means you're paying a second time, right? You're making a second payment to buy the second set of protection. Right, that means you're going to start to yield negative results, right? Because money is going to come out of your pockets, right? So you're probably better off holding on to the stock, right? Because if you want to own the stock and you have held it for long enough, that means you believe in the potential of the stock, right? So, for example, right, if you own DBS over here for $25, right, and then it goes down to $15, right? I'm sure you'd probably be comfortable holding it at $15, right? And just let it climb up from there, all right? So something like that. All right, so the stock is still the biggest part of the puzzle, right? Make sure you're definitely comfortable with the stock when you're using such a strategy. Okay, all right, welcome, James. All right, remember, any questions that you have along the way, right, do post them in the comment section, right? And we see more people joining us right now from all our various platforms, right? So if you're joining us right now, okay, remember, right, to click on the share button over here, right? Click on the share button, and we'll be posting the downloadable link, right, for the summary strategy sheet that we prepared over here for all of you, okay? All right, welcome, James. All right, now, so let's discuss all the potential outcomes over here. Now, first, if the stock goes up, all right, now, so if the stock goes up all the way to 50, you get to keep the premiums, which is paid to you, all right, which is 159, all right, and you also make 99 cents profit from the stock because you bought it for 44.01, all right, and you have to sell it to someone at 45, which is the call option strike that you sold, okay, and at the same time, right? In our example, actually, you would have pocketed 3 dividend payments, each of 87 cents from ExxonMobil. So your total profit, right, including dividends over that period of time, is going to be $5.19. Okay, $5.19. That still brings you an 11.8% return over a span of 8 months, right? For this trade example that I put up over here. Okay, right now, pretty decent, right? Pretty decent considering you have like a 25% downside protection. Okay, all right. Now, next, if the stock stays at 44, right, of course, all you're going to make is the premiums, which is paid to you from day one, right? On top of that, the 3 dividend payments, which means you still make $4.20, right, which equates to $9.54% return in 8 months. Right, still pretty decent because they're definitely paying you more than your fixed deposit rates or any commercial plans that you get, right, at your neighborhood friendly bank. Right now, lastly over here, lastly, if the stock goes down, all right, what are you looking at? The same 9.54%. The premiums that you get to keep, all right, and the dividend payments from the stock. Right, so is there a risk? Yes, there is what we call a bankruptcy risk. Okay, right now. So can you avoid bankruptcy risk? Most people will say no, but technically you could, right? Technically you could simply by choosing a business or a company model where you could ask yourself this simple question: do I ever foresee, or can I even foresee such a day where this particular company could actually go bust? Right? If your answer is no, then you have avoided that risk from the very beginning. Right? What do I mean when I say this? Right? Ask yourself this simple question. Right? Do you ever foresee Colgate-Palmolive could go bankrupt one day? If your answer is no, then you just satisfied that requirement, right? Which means the downside risk that you're looking at is really, really very controlled in this environment. Okay, all right. Now, any questions before I go to some live trade examples over here? All right, and then we'll pick out some trades. All right, and we'll have a look at them. Okay, all right. Now, if you don't have questions, but you have some really high risk stocks that you're looking at acquiring, right? Maybe we could use those stocks, all right, and structure a collar trade for them, all right, and see if you like the returns that can come out of those stocks. Okay, now, so if you have some really, really risky stocks over here, right, that you're unsure about, yet you're thinking about acquiring some of them, right, leave those stock symbols in the comment section as well. Okay, do understand we need options to achieve this, means those stocks have to be listed in the US stock market, all right? Okay, they have to be listed in the US stock market. Okay. All right, so I'm going to leave some time over here. I'm going to wait for some comments while I move my slides and screen share, right, to my trading platform over here. Okay, all right, so in the meantime, if you have questions, post them up. If you don't have questions, then feel free to start posting some of the stocks we look at. Okay, I'm going to pick 2 stocks that is going to be thrown out into the mix today. Okay, so today we're going to cover and take a look at 2 stocks from the entire mix over here. Okay, all right, give me a minute while I start to design and structure out. All right, maybe look for one model example over here. Give me a minute. Oh no. All right, done. All right, now let me pick out a stock that will probably fit the bill really, really well for such a strategy. Okay. Does not pass my criteria. Right, dividend morning. Right, great. Okay, I've got some stocks over here, so I'm ready to go. Let me get my broker's platform. Where's my broker's platform? Where did it go? It's missing. All right, Javon, I saw your question. I'll answer it in a while, okay? All right, let me get through my example that I want to highlight to all of you. Then we'll get to Javon's question. Okay, once again, all right, my broker's platform, I have to do the same thing. I need to change the settings, make the font size bigger, right, so you guys can actually see a little bit of something. All right, okay, now, so the stock that I want to highlight, for example, today is probably going to be SPG. All right, SPG. All right, now, it's this company in America called Simon Property Group. All right, so you could tell from the name, it's a property company. All right, so it's probably a landowner or a real estate owner, right, of multiple real estates in US. All right, and right now, with all the rental worries over here, all right, we may have some situations with the company. Right now, I may have to change my view on this company. Let me see the other company that I have on my list. Yes, this is better. Right now, so we look at OKE, all right, which is one OK over here. Right now, why did I change the stock? Let me tell you first. You can see when I load SPG over here, all right, they have cut their dividends, which means they've totally eliminated their dividends. So they're no longer paying dividends over here, right? So it would be, not ideal, right, to structure a collar trade on a company that does not pay dividends. One, because you're looking at what we call lowered returns, right, if the stock goes up. So if I don't even collect dividends from that stock that I'm owning right now, it really doesn't make any sense of why I want to structure such a strategy. Yeah, okay, or why I would even want to own a stock if I believe that there's limited upside. Yeah, okay, so OKE, all right, will make more sense because right now, if you buy the stock, right, the dividend return on the stock goes up to almost 10%, right? 10% on a stock. If I tell you, for example, if you're joining us from Singapore, if you get to buy DBS today and by buying the share at today's price, you get to create a 10% dividend return. Would you do so? Right? The answer is probably going to be 90% of you saying yes. All right, now, so yes, but is there risk? That's the question. Right, so for OKE, I think it deals with natural gas. Let me confirm that. All right, so let me go to the platform and type OKE. Right, looking at fundamentals is going to tell me what the company does. All right, now, so yes, that's right. Energy midstream service provider in United States dealing with natural gas. All right, so definitely one that packs risk. Now, so if you buy the stock today, it's going to cost you $36.26. Okay, now, so such a collar strategy has to be structured for longer term expiry. So same thing, we're going to look at all the way to 15 January 2021. Okay, so if I'm going to open that up, how can I structure such a trade? Now, so $36.29 is what I bought the stock for. So I'll probably have to turn around and sell the $37.50 call to keep a little bit of the upside potential, all right, just in case the stock goes up. So if I sell this, I could probably pocket somewhere in the middle. That will be probably what I'm aiming for, which is $5.50. And that happens to be the last done price as well. So that's definitely possible. All right, now next, I would turn around, okay, and of course, buy the $35 put option. All right, so buying the $35 put option, you could see, all right, it's going to set me down in the negative immediately. All right, the put option is so much more costly than the call option I'm selling. Right now, so there is no way else but to make sure, all right, I design a protection over here. Right now, so maybe I want to protect 35. Maybe we could go to the charts, take a look. Where is our trend? Right, so where is our trend? Probably somewhere all the way down to $20 over here, right, which is the much low and the much bottom. All right, somewhere around $20, all right, will be a decent downside we could look at. Now, so if I sell the 20, right, if I sell the 20 puts to make it a spread, all right, this shows me that I could still pocket about a 12-cent credit for the entire combo. nothing to shout about, but still it's a 12-cent credit. Okay, now, so the ex-dividend date over here, it's last paid on April, right? Which means 3 months down the road, we'll probably have 7, that's July, right? And then we'll probably have October, right? November, December, January. Oh no, we just missed the date. So we'll collect 2 dividend payments, right? Because the expiry date is 15 Jan, right? Dividend date in January will be 24th, right? Just after that. Okay, so 2 dividend payments of almost $1 over here, right? So that's pretty decent, right? 2 dividend payments will pay me 187, right? 187 from the dividend plus 22 cents credit, right? For the entire protection structure means I would make 187, 22, 209, right? 209. Okay, right now. So this means if the stock stays where it is, right, or if the stock goes down, right, but stays above $20, all right, by January next year, right, we would still make a profit of $2 and 187 plus 22. Right, so that's 209. Okay, all right now. So we still make a profit of 209 over here. All right, 209. So let me calculate right now. 209 divided by 36.26, which is my cost price to buy the share today. Right, that means I'm able to create about a 5.7% return. Right, 5.7% return in 211 days. Let's calculate that. Divided by 7 days, that's 30 weeks. All right, 30 weeks. Okay, right now, so you are able to create about 5.7% return in 30 weeks' time. If we have to annualize this rate, let me calculate that out, divided by 30 weeks, and then multiply it back up by 52 weeks. That means I'm still creating around 9.88% return annualized. Okay, if I annualize those rates, right, it works out to almost 9.88% return. Right now, what kind of downside protection do I have? I have a protection all the way until $20. Right, so if we're going to calculate that, that means 20 divided by 36.30 right now, we have a 45% downside protection. That means the stock can fall by 45% from today's prices, and we will still not lose on this trade over here. Okay, all right, we'll still not lose on this trade. Okay, now, so this is what we mean when you look at stocks and how you structure and design the trade. Okay, now, so let's go to Javon's question. Okay, now, so Javon's question is, if you're holding the stock, right, which is assigned to us at a much higher price than the current market price, how do we structure the covered call? Right now, in this case, in this particular situation, right, because the stock is sitting at a loss right now, okay, the stock is currently sitting at a loss, you have to first decide, are you willing, right, are you willing to let go of the stock at a loss and perhaps maybe restart again after that somehow? Okay, if you're not willing to do that, then the only case, right, that you could do is just to sit on it. Yeah, right. The only thing you could do on the stock is just to sit on it and wait for the stock to recover. Right? Because when you go out there and sell a call option, right, you are obligating yourself to sell the stock off, right, at the strike price of the call option, if it actually goes above that. All right, and there's no running away from that actually. Yeah, okay, all right. Now, so you have to be comfortable with that before you even begin. Okay, all right. Now, Hung Han, let me answer your question. All right, long time no see, Hung Han. All right, now, hope everything's fine in Penang. All right, now let's check out your question. Stock price goes up, exceeding the call strike. Can I roll out further to avoid selling the stock and increasing the price appreciation? Yes, that's definitely much more technical over here, but the answer is yes. Technically, you can. All right, so which means come those time over here, if, for example, OKE goes up to $38, right? You could probably close off the 37.50 call and then find a further expiry and then sell maybe like a 40 strike call option. All right, now, so you could do that, but you also have to make sure that you get a credit to do so, right? Otherwise, you're just paying, right, for that potential extra upside that you're looking at. Okay, all right, now, so the theoretical answer is yes, all right, but you must know the numbers that you're dealing with over here. Okay, Hong An? Right now, so I hope I answered those two questions. Now let's go and look at James' stock over here. His suggestion is AZN. We'll have a look. And then Christine's stock, which is QCOM. All right, QCOM. Right now, so we'll look first at AZN. All right, pardon the noisy bites at the bottom. All right, now AZN is definitely doable. All right, now why would I say doable? Because it has a dividend. All right, it has a dividend. So that's pretty good. All right, now, so let's take a look right now. Wait, let me have a look. Ah, nice. So this is how the broker's platform tells you how the dividends are paid. Can you look at the dividend frequency over here? If it writes Q, right, that means it's telling you that dividends are paid quarterly. All right, so quarterly. You see, oh, no, change the policy. Oh, no. Forgot the stock symbol, which I wanted to look for. Well. Where was I going? Oh, sorry. Got distracted a little bit. Right now, so you look at AZN, which James suggested over here. It says S. That means it's semi-annual. Right? Semi-annual. All right, okay, so semi-annual means you only get 2 dividends payments a year, right? So that's 95 cents for every 6 months over here. So holding on to the stock, right, until January expiry, right, which is 2001 January, right, we are only entitled to 1 dividend payment, which is going to be 95 cents over here, right, 95 cents. So let's look at the structure we could have, right? Now, the only nearest call option you could sell is $55 if you want some upside potential. All right, so upside potential would mean you sell the 55 call. All right, and protection wise, you turn around and buy the 52.50 puts. All right, protecting it right on the dollar right now, okay, because the stock is sitting there. All right, but let's see what's the bottom. The bottom in March is somewhere around 36. All right, 36. So if I want to protect all the way there, right, I would sell the 35 put spread, right, which means I got my maximum profit covered all the way to this ride. All right, so 35, if I sell it, all right, I would have to pay for this. All right, so James, you could see, right, this is probably not going to be a very good structure, all right, on this particular stock, because to get this protection in place, all right, I'll probably have to pay for it. Right now, is there a way to change the design? Right, that means we are talking about a tweak right now. The answer is yes. Right, okay, the answer is yes. Let me undo this because it's blocking the view. All right, okay, now great. Now, so you realize by structuring it this way, all right, I would have to pay a debit, all right, which means I have to pay for the protection. Now, there is a way to change the design, which means, all right, you don't want and you're willing to forego any upside potential. Right, no upside potential at all, right? That means you're allowed to sell the 52.50 call, which is where the stock is right now. Okay, now if you do that, I'm sure you could get a positive credit. Oops. Oh no, too much demands on my computer. There we go. All right, now, so once you lower the call strike and accept no capital appreciation, all right, it will pay you 50 cents to protect yourself. Okay, it'll pay you 50 cents to protect yourself up front, right? Plus, the only profits you could make is probably going to be the 95 cents dividends that you get paid once, right? So that means you're looking at about $1.47. Okay, $1.47. So the returns aren't going to be too fantastic. Right, so AZN is probably not going to be a good candidate for the caller. Okay, all right. So James, I hope that helps you understand the numbers and see if it's worthwhile putting on such a trade on that stock. Okay, all right. Now next one over here. All right, QCOM. All right, now QCOM over here pays dividends. All right, it does so quarterly. All right, so the last payment was made on if I'm not wrong, this is American date, so it should be 3rd of June. Right, so 3rd of June means I'll probably be looking at 2 more payments. 2 more payments, which means I can collect about 130 in dividends before the January expiry. Okay, so I'm collecting 130 in dividend payments before January expiry. Okay, call strike. Okay, somewhere really, really near, which is 90. All right, right on the dot, like a 10-cent profit. 10-cent profit. Right now, and at the same time, I can protect right on the dot as well by buying the 90 puts. Right, where was the bottom for QCOM? Wow, the bottom was somewhere around $60. Now, this might make it challenging and difficult, but let's have a look. $60. Wow, it's possible. Look, everyone. I could protect myself on QCOM all the way down to $60. That means I sell the 60 strike put option. And here's the wonderful part. I'm still going to get paid 122. All right, that means I'm going to get someone to pay me 122 over here, right, to structure this modified collar or the impossible collar on QCOM, all right, on QCOM over here, and still, all right, make a profit. All right, and I get a protection on QCOM all the way down to $60. Right, $60. That's 33% protection on the downside. Okay, 33% protection on the downside. What's my maximum profit? Because I'm selling the 90 call, that means I'm capping my maximum profit right here. Right, because 10 cents, let's just ignore the 10 cents. Okay, right, so the maximum profit is going to be the 122 credit that I'm going to get paid, plus the 2 dividend payments, which adds up to 130 over here. So that's 252 in total, divided by, I'm just going to round up to 90, right, to buy the shares. That means I'm going to make about 2.8% return, right? 2.8% return, nothing to shout about, nothing to shout about. But if we divide this by 30 weeks, right, if I got this right, and then multiply it by 52 weeks, that's still a 4.85% return annualized. All right, 4.85% return annualized. Okay, now imagine this: you could get a downside protection on QCOM all the way down. All right, sorry, a downside protection of 33% from the current stock price, and still be able to generate close to 5% per annum, right, on such a trading deal. Okay, so like I said, if you're looking for something that pays better than just fixed deposit rate of returns, right, then this is something you could look at over here, right now. So I think it would match up, right? In fact, all right, if you're looking at something that beats even endowment plan returns, which is usually 3%, or the long-term inflation rate, this still beats that. Okay, all right, this return still beats that, all right, and the downside protection of 33%. Yeah, okay, all right, now, so I hope I analyze the numbers over here and, present a case and show all of you why this strategy works and, how options can really help people cover up their risk. So it's very dynamic, all right, because we have call options, we have put options that does different things for buyers as well as sellers of it, right? So by combining some of these structures, sometimes it may look complicated, but when you understand, all right, you can actually see the beauty of mixing them up to achieve what you really want to get out of the stock. Okay, all right, now, any questions? All right, I can probably take 2 questions before we sum up today's session over here. All right, could take like 2 questions before we sum up. So in the meantime, I'm just going to move the screen share back to my PowerPoint. All right, so Zen's question. Let's look at Zen's question. Technically, Zen, I think the best outcome over here is to see the stock sit around, right? Yeah, it's probably to see the stock sit around, because if the stock sits around, you'll probably still own the stock at the end of expiry, right? Which means you still get to keep all the dividends that the stock is going to pay you, right? And continue to keep the stock and get more dividends, right? And at the same time, keep all the premiums that you get from the protection structure of selling covered call as well as buying a put spread. Yeah, okay, so that would be probably the most optimized outcome, right, for the entire strategy. Okay, right, Zen? Right, any other questions? One last one before we wrap up today's session. Okay, while waiting for the question, I'll just sum things up as well. So today is going to be day 18 and tomorrow is Friday. Tomorrow it's going to be Friday. All right, now, so for Singapore, all right, it is also coming really, really close. I think tomorrow is the day, all right, if I'm not wrong. All right, we are free. All right, not exactly free, but we get more freedom. All right, okay, now, so I do hope some of you or most of you will continue to join me at 9 p.m. in the evening, of course, because tomorrow I'm going to cover about how you can use options to manage your risk. Okay, manage your risk, which means tomorrow we're going to talk about scenarios where if you own a stock, for example, you bought Facebook shares and you bought it at $100, right? And now it's gone all the way up to 250. You think it's going to continue to go up, but at the same time, you fear that somehow some event may cause Facebook share to drop by 50%. Now, so can you avoid those risks altogether? Which means, can you control that risk and still keep all the upside potential? Right now, can you do this with options? Tomorrow, we're going to discuss that. Right, so I mentioned before the start of this 30 days challenge, right, there's so many things you can do with options, right? We want to debunk them over here over the next 30 days, right? This is definitely for the benefit of my investment community, right? But also to the friends of people who are in my investment community, as well as general public who have gotten news of the Project Options Cashflow, right? And attend those sessions as well. Okay, now, so if you have not joined our Telegram group over here, right, the QR code is at the bottom left of the screen. Okay, if you don't know how to do the QR code, you could also type the link over here, right, into your web browser on your smartphone. That will be the best, right? And it will lead you to open up your Telegram app. So if you don't have the Telegram app, you probably need to download and install it first. Okay, and it'll pop up our Telegram channel, and you just need to click on the join button after that. Okay, right? Also, if you want to restart, okay, that means you probably missed out on our, how do we say this? We have missed out on day one of our challenge over here, all right? So the team has put down the banner at the bottom. You could go over to our website, which is www.impossibleinvestors.com, right? We can't add the apostrophe in URL, so it becomes impossibleinvestors.com, right? Look for the Project Options Cashflow icon, right? And then click on it, and it will lead you to enter some details, and we will start sending you the challenge from day one all over again. Okay, all right, now, seems like we're not going to get any more questions for today. All right, now, so I'm going to wrap things up. Tomorrow is going to be equally interesting over here as we've covered all the basic strategies. So now we go into the interesting portion of options. So managing risk with options tomorrow. So one way, how do you keep, all right, the upside potential of profits, all right, but start to control the risk of losing some of the profits you probably are already sitting on, right? Is there a better way to do it with options than to keep the stock, right, that you're owning right now? The answer is definitely yes. Okay, but how do you do it? Tomorrow we'll be discussing it, right, using some live examples and live prices. Okay, so thank you very much for joining me once again. Right, this is I'm Possible Terrence Tan signing off. Right, thank you. I like this comment. Right, I like this comment. Sai, right, wait, okay. So what am I waiting for, Sai? All right, let me know. All right, Sai probably has a question over here. All right, so Sai, I'll wait for another minute. Okay. All right, welcome, Christine. Welcome. All right, now, if any of you found today's information useful, all right, it'll be great if you leave a comment over here and just let me know that you have learned something today. Right, okay, and perhaps click on the like button as well to let me know you like a topic like that as well, because at the end of all our strategy sessions, right, we'll total up and see which strategy has the most likes, and we'll probably cover those strategies a little bit further, okay, after Project Options Cashflow month. Okay, right, so leave a comment, tell us that you have learned something. Right, remember to share the video as well to get the downloadable link for the option strategy sheet, okay, the I'm Possible modified collar, right, and click on the like button to let us know if you like the strategy that we'll share with you today. Okay, all right, welcome, Ching Kyung. All right, welcome. All right, Sai. Okay, all right, now Sai. Okay, now so let me jump quickly into Sai's question, and then we'll end the session after that. Welcome, Hockley. So Syed is asking about GT. Right now, so the only question with GT right now is first, all right, they have eliminated their dividends, so you have to start asking yourself, do you still want to keep the stock? All right, so if you're willing to keep the stock because you're saying it's still Goodyear tires after all right, the business is probably going to survive, right? Then the only thing you could do right now is to sit on the stock, all right, or right, if you are worried that there's more downside risk, right, then you could look at something like this, which is to sell the January next year, right? $10 call option, which gives you another 150 upside. Okay, $10 call option. Okay, which gives you a 150 upside to cover a bit of those losses from your purchase share price, and then maybe turn around, right, and buy the $8 put option, right, and then after that turn around after that and sell a $6 strike put option. So this pays you 42 cents, right, while you sit, right, and protect your GT shares all the way down to $6. Let's have a look. Right, so GT shares hit a bottom of around $5 over here. Right, of course it hit the 4, but it quickly bounced up. So we would say probably somewhere around 5. So yep, the $8 and $6 put spread would probably cover those downside risks over here from where it is today. Okay, so Syed, if you're willing to let go of the stock at $10, right, and then probably think about what you can do again after that, right, then this is something you could look at. You could get paid 45 cents credit, right, while you sit and wait for the stock to go back above $10 over here. Right, what's the downside? Right, you're going to limit your potential recovery of the stock price at $10, right, because you've committed to sell the stock to someone else at $10 over here. Okay. Right now, thank you very much for joining me once again in tonight's session of day 19 of Project Options Cashflow for the entire month of June. Now, this is I'm Possible Investors signing off for today's session, and thank you very much. I'll see you on day 19 once again. Bye-bye. All right, bye-bye, everyone. Good night.